Zimbabwe is capable of achieving its ambitious target of becoming an upper middle income economy by 2030 if it undertakes major policy changes. So says the World Bank. It's proposed 6 key pathways in its recently launched World Bank Zimbabwe Country Economic Memorandum, which aims at helping the country attain its goals. Some of the proposals include removing distortions and misallocation of resources, encouraging the formalization of informal firms, and taking greater advantage of regional trade integration.
With limited access to external financing, fiscal deficits had to be financed through monetary financing and quasi-fiscal operations, stoking inflation. At the same time, unsustainable debt levels and external arrears have meant low investment and infrastructure gaps, affecting negatively productivity. And last but not least, exchange rate policies have undermined economic growth and competitiveness of local exporters, while favoring a small number of importers and creating rent-seeking opportunities.
These are some of the major factors, as highlighted by the World Bank, attributed to Zimbabwe's poor economic performance over the last couple of decades. The country is now regarded among the poor nations of the world. Since taking over power in 2017, the country's President Emmerson Mnangagwa set out an ambitious 13-year plan to get the country out of its current position and become an upper middle income economy by 2030. But according to the World Bank, it requires taking drastic policy and behavioral changes.
The economy will need to grow at much faster speed than it's currently growing to converge to the upper middle income club. For the next 8 years, GDP growth will need to accelerate and be sustained at double-digit rates, and inflation at single digits for Zimbabwe to achieve its Vision 2030. Such high growth rates will need to be supported by significant improvement in the environment for investment and exports, open access to international financial markets, and favorable external environment.
For the past 2 decades, Zimbabwe has been battling economic sanctions imposed by the US, the UK, and the EU. Authorities have blamed the embargoes for the country's poor economic performance and lack of external investments. Zimbabwe has been forced to rely on a few exports, dominated by a few primary products and concentrated in just few destination markets.
Those who imposed sanctions on us are wondering how. They are wondering how we are progressing in spite of those sanctions. We shall progress and progress. Zimbabwe rise and we are rising. Zimbabwe is a roaring lion and will continue to roar. And the roaring of a lion instills fear to those who are against us.
The World Bank says Zimbabwe must sustain the current macroeconomic stability and significantly support exports diversification and participation in global value chains in order to achieve its goals. Kylie Kumalo, SABC News.
Let's speak now to Economist Eddie Cross. A very good evening to you, and thank you so much for speaking to us, Mr. Cross. So this is the first country economic memorandum since 1985. Let's first look at the significance of this and what has happened during this period.
Yes, I think this is a very welcome development by the World Bank. I think it's long overdue. And it's very interesting to read through that document and to see how they've summarized the major challenges facing us. I've often said that in 2017, we resembled a country coming out of a war. Our economy was really in an appalling state. I think that we remain one of the few countries in the world that really resemble a country that's been at war when it hasn't been at war with itself. But many of the things they say are absolutely spot on. Their call for major reforms of our foreign exchange system, I think, is central. I said to the Minister of Finance at the beginning of this year that, in my view, there was only one item on the table for him, and that was foreign exchange management. And I retain that view. And so far, we have not got to grips with that. But our economy is now growing fast. And in fact, I dispute often the numbers adopted by the World Bank and the IMF based purely and simply on the official statistics here, because I don't think they represent the real economy. Our economy is now growing fast, and we are creating jobs for the first time that I can recall for the last half century. Last year, we were creating jobs, about 10,000 jobs a month, and we really have seen a turnaround in economic activity. Partially that's driven by very high commodity prices internationally in the metals and minerals market, which continues through to today. And I see that continuing. In fact, our exports are growing very strongly, about 30% per annum at the moment, in real terms.
And
that's not inflation.
As we mentioned, the issue of the currency fluctuation has been spoken about in many vexed conversations, but exchange controls, that has also been cited. What suggestions would you make in terms of changes?
Well, our exchange control system is very much more relaxed than it used to be. In fact, I think our economy is freer than the South African economy at this moment in time. I think you guys have far stricter exchange control than we do. We have a balance of payment surplus. We have a fiscal surplus in the budget. So what the bank said about our macroeconomic stability is absolutely spot on. There's nothing wrong with us from a macroeconomic point of view. The main issue here is that we still do not have a conventional market for foreign exchange. All of our neighbors have. And where the conventional market for foreign exchange has been adopted by African states, it's immediately stabilized the currency and stabilized inflation, even under very difficult conditions. Somalia did it last year. We, for some peculiar reason, think that we're the great exception. We're not. And I think we've got to get to grips with this. And I think the bank has actually made a very, very clear analysis of what needs to be done. And I must say, I think in that respect, they've done a lot better than the IMF. The IMF tends to play its cards very close to their chests. They know what the problems are, but they haven't really spelt out what's got to be done. Now we have clear guidelines on what we should be doing. And I hope that the government is going to take cognizance. But if they do, my personal view is, like in Zambia, our currency would actually be stronger than the rand.
And just looking at this picture that we're beaming to our viewers now, it makes also a very interesting suggestion, that of boosting production in the informal sector and also boosting trade in order to scale up the formal sector. Just in terms of comparisons, often is a great deal of concentration on the formal sector, for instance, in South Africa. And I suppose in Zimbabwe, there isn't much of a choice because a lot of the business that is done is in the informal sector. Let's just look at the suggestions that are being made by the World Bank, but what you would add to it as well.
We're the most informalized, or one of the most informalized countries in the world. I personally think that our informal sector could easily be 70% or more of our economy. And our informal sector is very dynamic. In fact, I think without that, we would actually be in dire straits. The vast majority of our people make their living in the informal sector. And I think that we've just got to recognize that that's a reality. That's the facts of life. The fact that they don't pay taxes, they do pay taxes in some respects. They pay VAT. The transaction tax, which we introduced in 2018, collects a very substantial proportion of our revenue, and that cuts across all sectors of our economy, including the informal sector. But I think without the informal sector, our economy would be much less dynamic than it is. And the key here is, how do we harness it? How do we help these informal players grow their businesses and join the formal sector? And I think one of the main reasons, and I'm so pleased that the World Bank has identified the fact that we do not have free access to global financial markets because of US sanctions. I mean, I'm furious with the Americans when they say that the sanctions program is not impacting on our economy or our people. That is not true. The financial sanctions imposed by the Zadera Act, under which we've been operating for the last 21 years, have a profound impact on our economy, and they have denied us access to international financial markets. And as a result, we pay some of the highest transactional costs in the world. It's very difficult for us to make transfers of money into the global market. For example, one of our major companies the other day tried to buy a piece of equipment in Germany. They couldn't pay for it because none of our domestic banks have capacity to transfer money to banks in Europe or the United States because of US sanctions. And they had to ask a South African company to import that equipment for them and transship it to Zimbabwe. What the hell? It's almost as if we're back in the Rhodesian days when we were operating under UN mandatory sanctions. And that doesn't help us. And to say that the ordinary Zimbabwean is not affected by that is just nonsense. It affects every Zimbabwean. In fact, the bank talks about unsustainable external liabilities. We're in fact not heavily indebted. I doubt if our debts are even 50% of our GDP. We can manage our debt quite easily, but without access to international markets, we can't. We can't borrow money to repay the money that we owe other people. The United States doesn't repay their debt; they roll it over. So does China. So does Japan. And we're denied that right. We can't even negotiate our debt in the Paris Club. You know, how much longer is this crazy situation going to persist?